What's up, everybody? We have looked at Elevance, we have looked at UNH, and now it is time to continue our dive into the healthcare space and look at Centene. You're probably aware that I am bullish on this sector in general. I think a lot of these names are offering deep value today. I did a video not too long ago giving my basically bull thesis for the sector as a whole. I'll put that link in the description. And while I think a lot of these stocks are looking like interesting investments today, they sure haven't been fun to be in for the past 5 years. If you thought UNH was bad, just wait till you see Centene. Over the past 5 years, you would be still down 60% on your money. From the peak, this stock is down more than 70%. Just in the past month, you would have lost half. Now, full disclosure, I own Centene, so I may be biased here. I entered my position about a week ago, and I want to tell you why I think Centene is going to be a winner. If you get value out of the video, subscribe to the channel. If you want to buy me a coffee, I have a link for that in the description. Nothing is expected, but any support is greatly appreciated. Now, let's jump into Centene. Centene is an absolutely massive healthcare company. You might not know by just looking at their market cap being only $13 billion. But look at this revenue growth here. I mean, they've grown from just a few billion 15 years ago to now about 178 billion over the past 12 months. Now, while they have a ton of revenue, this is an extremely thin margin business. I mean, we're talking under 2% margins right now. Historically, they've been more like 2 to 3% operating margins. And that's because, I mean, not only is this a health insurance companies have very low margins in general, but they're really targeting Medicaid. A ton of Centene's membership is coming from Medicaid. Medicaid is under a lot of pressure right now. And this commercial segment right here, these aren't the employer-sponsored commercial plans that you think of. This is the ACA marketplace. These are individuals who go on healthcare.gov and they get their health insurance. And if you've ever seen something under the brand name Ambetter, that's Centene. They're also trying to expand their Medicare segment. This is not as big of a part of Centene as it is for other companies. In fact, right now, this Medicare segment is losing money. Centene has said that they expect to break even on this in 2027. So this isn't really a huge part of the business right now. Now, we have to talk about Medicaid. This is such a big part of Centene's business. I didn't get as much into this in Elevance. Medicaid is a significant part of Elevance's business too, but not nearly to the same degree as Centene. Elevance is focused on commercial, especially employer-sponsored plans. They're more insulated from the troubles that are really plaguing Medicaid right now. Now, you might look at this graph here and say, what's the problem? People on Medicaid keep going up and up and up. Wouldn't this be great for Centene? Well, I'm not exactly giving you the full story because you see that this chart here ends in 2023. During COVID, from 2020 to 2023, the federal government said to the states, hey, you cannot disenroll people from Medicaid. Keep in mind, Medicaid is a program that is run by the states. The states get subsidies from the federal government, but it's really the states that are running the programs. And Medicaid has certain eligibility requirements. You know, someone who's eligible for Medicaid one year, they might not be eligible the next. So, you know, the churn can be very high. These populations that are on Medicaid one year versus another, they can be rather different from each other. So from 2020 to 2023, if you're not allowed to disenroll anyone from Medicaid, then all of these people from 2020, they're all going to be on Medicaid in 2021, 2022, 2023, and you're just going to keep adding people who jump onto eligibility. So what you see is that Medicaid enrollment skyrocketed and there weren't any people coming off. Now in 2023, these eligibility reviews resumed. So people would have to go through redetermination to basically redetermine, hey, are you eligible for Medicaid? And here's what happened after 2023. Medicaid enrollment dropped by about 13 people over the course of a year, and now it's actually down a little bit more. Second quarter of 2025, this dropped a couple more million from 81 to about 78 million. So now we're done with this period of redetermination. We're not going to have steep drops like this in Medicaid anymore, but if you're just looking at earnings over the past couple years, you might see, hey, wait a minute, what happened? All these people came off of Medicaid. And for a company like Centene, where an enormous amount of their business is from Medicaid, that's going to be a hit to the growth. You see that their year-over-year growth dropped significantly in this period. And while Medicaid enrollment has been dropping, the type of people who have been leaving Medicaid have disproportionately been healthier people. So the resulting population has definitely been more costly for Centene, and it was something that they underestimated. And in a business of razor thin margins, if your costs go up just a little bit, it can completely obliterate your earnings. And the problem isn't just Medicaid. Even in this commercial segment, in the marketplace segment, Centene mispriced their plans. Healthcare utilization is coming in much higher than they thought. And the way the ACA marketplace kind of works is health insurers, they can't deny people coverage. So if you're sick, if you're healthy, they'll sell you a plan. So you might think a great strategy if you were a health insurance company and you just cared about making money is, let me just advertise to young, healthy people and I'll insure this healthy population and they won't use the healthcare benefits that much. So to deal with this, the government has risk adjustments that they make to health insurers. So if you're a health insurer and you're insuring, just a bunch of really healthy people who aren't using much health benefits, then you have to pay an additional risk adjustment for your population. And if you have another health insurer over here who's insuring a more sicker, more costly portion of the population, then they're going to get those payments to them. They're going to get a risk adjustment payment coming in to them. This is pretty much a zero-sum operation. If you're taking from someone, it's going to someone else. Now, Centene thought that they were going to get a big payment coming to them, a big risk adjustment payment coming, because they thought they were insuring a sicker portion of the population. But what's actually been going on is that the ACA marketplace as a whole, not just the people Centene is insuring, but Oscar, Molina, everyone who's insuring people in the ACA marketplace, that has become a sicker population. People who are healthy are disproportionately choosing not to just be involved in the marketplace. So Centene thought they were getting a risk adjustment payment coming their way, but it turns out that their population is actually no sicker than the rest of the marketplace pool. In fact, Centene may owe a risk adjustment payment to other players here. This is a huge hit to Centene's business. So Centene is under pressure across the board, and that brings us to this month. In the beginning of July, Centene dropped 40% in one day when they came out and said, hey, we are removing our guidance. We are not going to hit our numbers. It is going to be ugly. And if you thought United cutting their guidance or Elevance cutting their guidance to $30 earnings per share was bad, let me tell you, this was much worse. Elevance, UNH, they have a big health services segment of their company. They are also very much involved in employer-sponsored plans, higher margin portions of the market. They have things to buffer the headwinds a little bit. Centene does not. They are fully exposed here. They had a previous full year 2025 adjusted earnings per share guidance of $7.25. The stock is trading for less than 4 times that right now. Well, obviously they're not going to hit this number, but they came out and adjusted it down to $1.75. This is not a small miss. I mean, this is one of the biggest drops in guidance I think I've seen from a major company in recent years. But now that we've gone over the business and you understand the pressures they're facing, I think you probably understand what happened here. This is such a low margin business that when they experience headwinds that they didn't see coming, the earnings just go to zero. And this is a reason why Centene, I don't think it deserves to trade for the same multiple as Elevance or UNH. It's just a riskier company. Their exposure to Medicaid and marketplace and the fact that they're so low margin, it inherently means that Centene is going to have higher volatility in their earnings. And this was indeed a really bad earnings report. I mean, they're reporting losses for the quarter. Health benefits ratio, which is representing their costs, is through the roof. Top line revenue was not the problem. Revenue grew very well. It's the margins. So you might be thinking at this point, this all sounds pretty bad. Why would we want to invest in this company? Well, it really comes down to what we have to pay and what the risk reward is from this price that we're offered today. On the earnings call, the management was really saying all the right things. We believe we are on track to reprice our marketplace business for meaningful margin improvement in 2026. We have far more clarity on trend and market morbidity dynamics, and we have integrated this view into our 2026 refiling decisions and are making excellent progress against our goal to reprice 100% of the marketplace book. They're saying they think they can reprice the entirety of their marketplace book by next year. And by the way, the marketplace book, they're saying right now, this is a $2.4 billion headwind for the earnings this year. Now, it's not just Centene. All of these companies pretty much mispriced their marketplace offerings, but Centene is just much more exposed here. The hit to Medicaid and marketplace, we're seeing that way more in Centene's numbers than we are in, Elevance, for example. We're expecting to improve profitability in the book for 2026. We believe we have a path to reprice 100% of the marketplace book for profitability in 26. This statement right here is what I wanted to hear from management on the marketplace. And as far as the Medicaid segment, they said, as a reminder, 88% of our Medicaid franchise gets re-rated between July 1st and January 1st of next year. So they're going to get new rates. Obviously, the goal is that these rates increase to become more in line with the costs that we're seeing in Medicaid. They say we are pushing for faster rate correction on our July 1st and September 1st rates. They've materialized better than our previous expectations. We now expect a 2025 composite rate adjustment of 5% compared to 2024. This is stronger than the previous expectation of 4%. That might not seem like a huge difference, but keep in mind a little bit of rate improvement here goes a long way when you have as thin margins as they're dealing with in the Medicaid segment. A 5% versus 4% increase in Medicaid rates, if they reprice 88% of their book, this is probably about a $400 million pre-tax difference. So absolutely massive. All in all, yes, the earnings were very ugly, but the management said the right things. And the question is, do we think that these earnings is this a systemic problem that's going to last for years? Or in, say, 2027, are we going to look back and say, man, that was a horrible year in 2025, but, we're pretty much back to normal? Obviously, I can't know for sure, but it sounds to me more like the latter. I think they're going to reprice their plans, and I think margins are going to normalize. And when they came out with this earnings report, I think the stock dropped about maybe like close to 10% pre-market, and then once the bell opened, it actually was up. By the numbers, this was a horrible report. They cut their guidance from $7-something earnings per share to $1.75, and they were up on this. Or maybe we should say flat because the next day it was down. So it's roughly flat on this earnings report. When you release such a bad report like this and the stock is flat or even up, to me, it says that a lot of the bad news is priced in down here. I think if you have the slightest hint of a recovery, the upside potential is quite massive. Another risk we haven't really dived into yet is, what's going to happen with the big, beautiful bill, as they call it. Is this going to lead to more cuts in Medicaid? Are federal subsidies to marketplace going to decrease? There's a lot of unknowns there. I don't know the answers. All I know is it's going to increase the variability in future outcomes. So let's go back to our sheet and let's ask what we could expect for a return on our investment today if we invest in Centene stock now. I am assuming that they're going to grow 5% on the top line. This is less than their historical growth, but I have some concerns about Medicaid cuts from the big, beautiful bill. I don't think top line growth is going to be what it has been. I'm not giving them benefit for a full margin recovery. I'm only putting them back to 1.5% operating margins. I'm giving them no credit for free cash flow for 2025 and just 0.5% of revenue being returned to shareholders, hopefully in the form of share buybacks in the future. And I'm giving them just a 10 times multiple, which I think is fair for a company like this. I mean, maybe it's even a little high. You could go lower. Even with an 8 times multiple, I'm looking at a 17% annualized return over 5 years. With a 10 times multiple, you're looking at almost a triple over 5 years. I think this is about 170% gain. Keep in mind, by the way, this company has historically used a lot of their free cash flow to buy back shares. It looks like the shares jumped massively in 2020, but that's because they acquired WellCare. WellCare was a company that really expanded Centene's exposure to Medicaid and Medicare, and they acquired this company through I think 70% stock transaction. So that's why the shares jumped up a ton in this year. And then you see they've been buying back a lot of shares, actually. If cash flow returns and they're able to buy back a significant amount of shares down here at these prices, it could be very accretive to shareholders. Now, coming back, our bear case here, we're looking at no revenue growth on the top line. This would be a scenario where the big, beautiful bill maybe reduces Medicaid enrollment. I'm also assuming operating margins stabilize around 1%, which is absolutely razor thin. This would basically be the case where they don't recover from this. I'm giving them no free cash flow for 2 years, and I'm only giving them a 7 times multiple. I mean, I don't know how much more pessimistic I could be. This would be a very ugly scenario. And if this comes true, you are losing 3% of your money every year for 5 years. Yes, that would be bad, but as far as a really ugly, pessimistic scenario goes, it could be a lot worse. I think you see that a lot of bad news is already priced in the stock at its current levels. Yes, cheap can always get cheaper. This stock could go down more. I don't know, but if the stock gets much cheaper than it is today, you'd be looking at a positive return even in a horrible scenario like this. And as far as my bull case is basically the company returns to essentially what it was a couple years ago. High single-digit growth on the top line, 2.5% operating margins, about 1% of revenue is going to free cash flow, going to buybacks, and I'm giving them a 13 times multiple. These are not some crazy out of the world numbers I'm giving them. I mean, just look at the metrics this company had from 2017 to 2022 or whenever. And if this comes true, if the company just recovers from today, you're looking at a 50% annualized return on Centene stock. I mean, that is just an insane potential upside. Please tell me where I'm wrong. If you disagree with me, tell me why I'm wrong about these numbers. Now, admittedly, this is an absolutely enormous difference in potential returns from my bear case to my bull case. Normally, I'm not seeing a disparity quite this wide. But overall, when I look at this, I think the risk reward is pretty good. I certainly would never be putting like half of my portfolio in Centene, but I think the upside is asymmetric. I think just if they recover, the upside is so huge, it deserves a small position in my portfolio, and that's what I have. Honestly, if the stock remains around these prices, I might add to my position and increase it. It looks like no one on Centene's management wants to sell at these prices today. In fact, some of them were buying around the $50, $60 price. When Centene comes out with their next quarterly results, I think we'll have a bit more insight on what Medicaid rates are looking like. I don't think we'll see much recovery in the fundamentals till at least 2026, but I'm in for the ride. I own this stock. If you got value out of this video, subscribe. If you want to buy me a coffee, links in the description. And if you agree or disagree with anything I said, leave that down in a comment below. And I hope to see you all in another video.